Hey everyone, welcome back to Corporate Decoder, the place where we unravel the mysteries of your favorite companies. And today we're diving deep into Groove Botanicals Incorporated's latest quarterly report. Get ready because this one is a masterclass in creative accounting and strategic pivots. Or maybe just a company trying to find its footing. Before we jump in, if you love getting these no-nonsense breakdowns of financial filings, make sure you are subscribed. We also have a fantastic community on Discord, linked in the description where we discuss these things and more. Scroll the 31st of December 2025 scroll. Alright, let's get into it. Groove Botanicals Inc., or Groove as you might know them, has just dropped their Q3 report for the period ending the 31st of December 2025. This is a company that's been around the block, changing names and industries more times than a chameleon in a disco. They started as an oil and gas company, then apparently pivoted to snow skates. Then to something called xdogs.com, then back to Avalon Oil and Gas, and finally landed on Groove Botanicals. Talk about a resume. Now they're aiming for the EV battery tech market, hoping to snag some government grants and find corporate partners. It's a bold move, especially since they don't actually own any patents or tech in this space yet. Looking at their balance sheet, things are pretty lean. As of the 31st of December 2025, the company reported total assets of just $6,260. Compare that to the 31st of March 2025, where it was $4,520. Not exactly a huge jump, but it shows some growth. Most of that small asset base is tied up in cash and prepaid expenses. On the other side of the balance sheet, we see liabilities. Accounts payable and accrued liabilities hovered around $63,641 at the end of 2025, down slightly from $68,608 in March. But then there are these related party payables, which are a significant chunk of their liabilities. These shot up from $608,833 in March to a whopping $719,961 by the end of December. And don't forget the dividends payable, which also increased significantly. Now let's talk about stockholders' equity, or in this case, a stockholders' deficit. For both the 31st of December 2025 and the 31st of March 2025, the company actually has a negative stockholders' equity, sitting at a deficit of over $1.3 million and $1.1 million respectively. This means that if you were to liquidate all their assets, there wouldn't be enough to cover the company's debts, let alone pay back shareholders. It's a classic indicator of a company that's not quite on solid ground yet. Moving over to the income statement, Groove Botanicals continues to operate at a loss. For the 3 months ending the 31st of December 2025, they reported a net loss of $33,867. This is a slight increase from the $33,031 loss in the same period of 2024. The story is similar for the 9-month period, with a loss of $104,420 in 2025 compared to $99,404 in 2024. None of this revenue is coming from actual product sales, as they are still in the very early stages of acquiring technology. A big reason for that loss, especially when you look at the loss attributed to common stockholders, is the dividends on preferred stock. These are fixed costs that hit the bottom line regardless of revenue. For the quarter, it was $54,618, and for the 9 months, it was $163,852 in both 2025 and 2024. This means that even if they were profitable, a big chunk of that would go to preferred shareholders before common shareholders see anything. Digging into the equity statement, we see how these losses and preferred dividends chip away at the company's net worth. The accumulated deficit has grown substantially from $35,196,581 at the end of March 2025 to $35,464,854 by the 31st of December. This is a consistent trend of the company spending more than it earns, and that preferred stock dividend is a consistent drain. Now, cash flow is the lifeblood of any company, and Groove Botanicals is burning through it as expected. For the 9 months ending the 31st of December 2025, they used $75,675 in operating activities. That's an improvement from the $89,329 used in the same period in 2024. But it is still cash going out the door without revenue coming in. Most of this is driven by their net loss. Where are they getting their cash then? Financing activities. For the 9 months ending the 31st of December 2025, they brought in $75,127 through financing, primarily from related parties. This is essentially money coming in from management or entities connected to management. This is crucial because without it, they wouldn't be able to cover their operating expenses. The report mentions funds received from a related party, which is essentially injecting cash into the business to keep it alive. The company's history is quite a story. After bouncing between various industries and names, they've landed on EV battery tech, a hot area they aim to partner with universities in Norway, Sweden, and Finland, and get grants from Minnesota to commercialize these technologies. The catch? They don't own any patents yet, and acquiring them can be pricey. Management believes this sector offers a stable business model with high growth potential. It's a hopeful outlook, but grounded in a lot of ifs. This is a critical section for any investor or potential investor to pay attention to. The auditors have expressed substantial doubt about the company's ability to continue as a going concern. This is due to recurring net losses, limited capital raised, and a growing accumulated deficit. They've had losses for 9-month periods ending in 2025 and 2024, and this accumulation of deficit is significant. The company is trying to address this by focusing on its new business model and seeking equity or debt financing, but the auditor's statement is a serious red flag. This note really sheds light on where much of the financial activity is happening. The company has significant related party payables, meaning they owe money to entities or individuals connected to management. These amounts are substantial, indicating a reliance on personal financing to keep operations running. They also detail the compensation for their CEO, Kent Rodriguez, including a contract for $4,000 a month and accrued preferred dividends. It shows a very tight-knit circle of financial support. This is where we see the other side of those preferred dividends. Groove Botanicals has Series A and Series B preferred stock. The Series A has a 51% voting power for its holder, Mr. Kent Rodriguez, and specific conversion rights. Series B also comes with dividend designations and liquidation preferences. The details about accrued dividends, particularly for Mr. Rodriguez, highlight the fixed financial obligations the company has, which can significantly impact its bottom line and its ability to generate profits for common stockholders. In their discussion and analysis, management emphasizes their pivot to EV battery tech, the need for capital, and their reliance on their single officer and director, Kent Rodriguez, for management and financing. They're upfront about not having products yet and needing between $500,000 and $5 million for business development and acquisitions. The key takeaway here is their clear acknowledgement of their early stage status and their significant need for external funding. This section reveals a significant weakness in the company's internal controls. Due to management consisting of only one person, there is a lack of segregation of duties and no formal audit committee with financial expertise. This means oversight and checks and balances are severely limited. They are working with an outside accounting consultant to help prepare financial statements in line with generally accepted accounting principles, but the structural issues remain. This is something investors should be very aware of. Finally, we see the required certifications from management, including those required by Sarbanes Oxley. These are standard procedural filings, but they underscore the fact that management is attesting to the accuracy of the financial information presented, despite the noted control deficiencies. So, what's the story here? Groove Botanicals is in a phase of significant transformation, attempting a high-stakes pivot into a burgeoning industry. Their financial figures paint a picture of a company deeply reliant on related party financing and operating at a consistent loss, with a substantial accumulated deficit. The auditor's going concern warning is a loud alarm bell. However, their strategic focus on EV battery technology, if successfully executed, could represent a significant opportunity down the line. The key risks are their lack of existing technology and patents, their substantial need for capital, and the structural weakness in their internal financial controls. It's a high-risk, potentially high-reward scenario, but currently the risks heavily outweigh the tangible achievements. What do you think about this pivot and the company's financial health? Let us know in the comments below. If you found this analysis helpful, please give it a thumbs up and consider subscribing for more in-depth corporate breakdowns. Don't forget to join our Discord community linked in the description for ongoing discussions. Thanks for watching, and we'll see you in the next one.